The S&P 500 looked like it wanted to bounce back after yesterday's beatdown, but we ended with a whimper and the S&P 500 closed lower yet again. We saw that same type of theme play through with a lot of the other indices as well. The Russell 2000 did close a little bit higher, but other than that, we didn't get much of a bounce back here today at all. We saw a lot of the same themes as we discussed a couple of days ago, which is money rotating out of technology and into areas like financials, like energy. So we'll talk about that. From a sector perspective, we'll also talk about the exertion of energy needed to push a stock from a low level on a multi-month basis to a high level, and then the expectation of a further breakout beyond that. We'll then apply that with our trade application example at the end of tonight's video, where I did want to focus on a bull put spread on a bond ETF. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 6th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below. Under our description area, you'll find a link to sign up for our email distribution list, which would entitle you to receiving notifications whenever we get these videos posted. Also, at the bottom of those emails, don't forget about those stocks that are exhibiting oversold and overbought cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related tweets. You guys did a great job for me last time around with over 100 of you doing that pretty easily. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And let's go ahead and get started here with our heat map of the S&P 500 to get a sense of some of the patches of strength versus weakness within the market here today. And this was another day where we saw strength in the two sectors that I mentioned in Tuesday's video, which was energy and financials. We had a good conversation about that, as a matter of fact, yesterday in my factor-based swing trading class, saying how it was reminiscent of exactly 1 year ago. Some of you might recall that as soon as December turned into January last year, we saw like a light switch, the energy and financial stocks go from being somewhat less enthusiastic to being strong leaders within the marketplace. We'll see if that kind of comes to fruition again in 2022. But while the year is young, so far so good on that count. You can see here stocks like JP Morgan, stocks like Bank of America, Wells Fargo, Citigroup, PNC, TFC, SIVB, that actually happens to be one of our stocks from our top-down trend trading class, KeyBank, we've got Chubb and Travelers. I mean, lots and lots, even over here with Schwab and Morgan Stanley up. So a number of financials doing quite well here today. In addition to that, you can see down below here in this energy area, pretty much all the energy stocks were up today, at least in the S&P 500. ExxonMobil is one of the bigger ones. They're up 2%. But you saw Chevron up nearly 1%. Conoco was up almost 4%, and so on and so forth. So some really big movers there within both financials and energy. And what kind of impresses me is the consistency within those sectors of green, right? It's not kind of half and half split. It's pretty decidedly green within those areas. When you start looking at some of these other sectors out here, there we do have some differences. In terms of which ones did poorly, I would say that there was some pretty consistent weakness within materials here today. Notice this little patch of red down at the bottom of the screen here. Stocks like Linde Energy, or I should say Linde Air Gas, was down about 2.5%. We had a paint company, Sherwin-Williams, down about 1%. Nucor, which was a steel company that was up a whole bunch yesterday, was right back down 5% today. Newmont Mining, a big gold mining company, down nearly 3%. So there was some pretty obvious weakness there within materials today. We also saw weakness within utilities today. Notice the consistency in the red down there in the lower right-hand corner, led to the downside by NextEra Energy, down 4%. Remember, that company has become very large over the years. It used to be the old Florida Power and Light, actually a pretty good dividend growth company. It's in the S&P 500 Dividend Aristocrat list, but the stock has really caught fire over the years compared to most other utilities, as a lot of folks look at it as more of an alternative energy type of a company these days. But today, not so exciting returns for it, down 4% right there. So seems like those were a couple of the areas that really lagged. I'd say healthcare, probably also a bit of a laggard here today. A lot of red in that healthcare space. In terms of some of the bigger movers on the left-hand side, remember this is where we get the mega cap types of companies, Apple and Microsoft, Amazon and like. Here was a little bit more of a split decision. Remember when I was with you on Tuesday, it was pretty obvious that the market didn't want to have anything to do with those large growth companies. And then, of course, yesterday was the follow-up to that, where the market collapsed even further, the NASDAQ down over 3% yesterday. Well, they couldn't get much in the way of rebounds today. At least Microsoft and Apple weren't able to do that. NVIDIA was able to get a little bit of a bounce, up 2%. Salesforce, a little bit of a bounce, but they were trounced yesterday. And then Facebook/Meta Platforms was up 2.5% today. So there was some tiny patches of green in there, but for the most part, I would kind of call what we see on the left-hand side here mixed results. And again, stressing that today's winners were financials, probably benefiting from interest rates. Utilities were underperformers for the exact same reason, surging interest rates, and we'll talk about that a little bit later on in the trade application example. And then we had energy companies doing really well today because oil prices did surge nicely. And then materials fell, and I'm not exactly sure what would have caused that. There might have been some company-specific news that caused it. Otherwise, sometimes materials do move around a bit with the dollar. So we'll check in a little bit on that once we get into our 12-grid analysis here after a bit. Let's go ahead and now take a look at our 4-grid of the 4 major market indices here in the United States. We do have some interesting differences in the chart, and that was kind of the theme of Tuesday's presentation that I gave you as well, and it continues to be the case right now, and it should be very obvious if you're familiar with looking at our color coding system that we use on these charts. So again, for those of you that are premium members of Market Scholars following along at home on your own charting package, this is chart 4B right here. Friendly reminder, I mentioned this on Tuesday as well, but for the NASDAQ composite, if you still have the old ticker symbol in there in the lower left-hand corner, you might have to replace that with $comp. And I will plan on getting the new shared links out to all of our premium members here sooner or later. I'll probably have some time to spend on that tomorrow. Fridays tend to be a bit more of a project-oriented day for me, so we'll see if I can get some headway on that. But in the meantime, just know that $comp will get you done there in the lower left-hand corner for the NASDAQ composite. Now, in terms of the haves versus have-nots type of a market, take a look at the 2 top charts, then take a look at the 2 bottom charts. The top 2 charts still have a green background color, and they still have a green moving average. Those top 2 charts are the S&P 500 and the Dow Jones Industrial Average. Both of them finished lower today, but they didn't collapse, and therefore they are still retaining some evidence of previous bullishness. Keep in mind, tomorrow could be an interesting day and an important one, as we do have the first Friday of each month be the jobs number. And that does have the possibility of moving markets. It is one of the more important and market-moving economic reports that comes out. So remember, that's once a month, the first Friday of every month. So that's tomorrow. So we could have a little bit of extreme movements, one direction or the other. Right now, we are right on the cusp of seeing our bullish postures go to bearish. The reason I say that is you'll notice that, for instance, on the S&P 500, that green line is basically sitting right at that upper reversal zone level. You can read within the chart label here where it says intermediate 80.06 and falling. So remember, the upper reversal zone on the market forecast technical indicator is at 80. In other words, if this were to fall just a smidge, it would move to a weekly bearish posture. This background color of the chart would move from green to light pink. And if we even go up just a little bit tomorrow, that's probably going to happen, right? The momentum is already pushing it lower. If we get a big update tomorrow, it might get bailed out. But if we just kind of have a sideways to even a slightly up day tomorrow, you could very well still see that we move to a weekly bearish posture when David goes through his video for you this weekend. So keep your eyes on that possibility there. We've got a little bit more wiggle room over here on the Dow Jones Industrial Average, a little bit more breathing room there. Notice that the intermediate line is at 87 and falling. So if the Dow goes sideways or slightly up tomorrow, in all likelihood, it will continue to retain that strongly bullish posture. Going back to what I had mentioned on Tuesday's video, from my perspective, the Dow is our current leader, and that kind of continues to ring true here with the intermediate reading at 87, and the S&P 500 is kind of in second place in my eyes, and that kind of matches up with the intermediate reading of 80 as well. Now, along the same lines, you heard me mention in class or on this presentation on Tuesday that from my perspective, we might be seeing a switcheroo at the 3 and 4 position. And previously, I would have said that the NASDAQ composite was a leader over the Russell 2000. But as of Tuesday, I said that very well might be switching. Now, at that time, the intermediate line on the Russell 2000 was lower than the NASDAQ composite. But because of what I had witnessed that day, where the NASDAQ got smoked right there, and the Russell 2000 really held in there pretty nicely on that Tuesday. Now, they both got hit yesterday, but you'll see that that did cause some changes in the intermediate line. Now they have flip-flopped and kind of confirmed what I had already a hunch of on Tuesday, which is if you were to read these intermediate lines, NASDAQ composite at 45 is lower than the Russell 2000 at 48, and therefore if I were to order these and rank them by strength to weakness, I would say Dow Jones number 1, S&P 500 number 2, Russell 2000 number 3, NASDAQ composite number 4. And for those of you that haven't watched the video as long as others, be aware that is somewhat of a new conversation, right? Last year, the NASDAQ composite was a leadership group in big chunks of the year, particularly the first half of the year. So it's a little bit different to say that all of a sudden it's our laggard here. And one thing that I would point out in that regard is notice how far down below the moving average the NASDAQ composite is now versus the Russell 2000. Again, both of them got hit pretty hard yesterday, but the difference being the NASDAQ was already in that sell-off mode the day before, whereas the Russell 2000 was not, and therefore yesterday's big move kind of didn't hurt as bad, I guess you could say, on the Russell 2000 as it did on the NASDAQ, where there was already a significant sell-off from the prior day. So now all of a sudden you've got this big air pocket here on the NASDAQ composite, and you're basically sitting just below the Russell 2000's 30-day moving average right there. Don't get me wrong, I'm not a cheerleader for the Russell 2000. I don't think this chart looks very good either, but I would say that it looks a little bit better than what we're seeing with the NASDAQ. One thing I will point out about the NASDAQ is this location where we're at right now is somewhat intriguing. Note, first of all, that we did have a posture change today from weakly bearish to strongly bearish. Notice the background color going from light pink to dark pink. That happens when that green intermediate line falls below the chart's 50th percentile. So we're now back at a strongly bearish posture. But one thing that it does have going for it is it's kind of at an interesting horizontal support level. Notice that back here at the first week of December, and then again here in the middle of December, and then now where we're at, those are kind of 3 touch points in the same general vicinity there. So I'll be curious to see if the NASDAQ can hold these levels and maybe push higher from here. I'm not necessarily expecting it to go out and break those previous all-time highs from November 22nd. Remember, we've talked about that date quite a while in these presentations. I had mentioned previously that that happened to be the day when we sold half of our Microsoft shares when it had doubled for us. We got kind of lucky in hindsight that that was the day that that happened, because that was the day that the NASDAQ hit its peak. The S&P 500 hasn't really played out that way, right? The S&P 500 already took out those previous highs. So again, S&P 500 in my eyes as being a broader based index is going to be a bit stronger right now than the NASDAQ composite that is still kind of driven by growth and technology. One thing that, in addition to those, that triple bottom possibility there, remember that's just a possibility because the trend is still negative. All else being equal, you expect the trend to hold until it doesn't. So this is the first possibility of where it might not hold, but that is not necessarily the expectation. So keep that in the back of your mind. But one other thing that we'll talk about once we get to the trade application example today is interest rates. And remember, because of the kind of long duration assets that tend to make up the high octane disruptive types of growth companies that are in the NASDAQ composite, if we do have a snapback in the interest rate environment, that might also help support the NASDAQ at this level. So again, I'm not here saying that that is likely. I'm sitting here saying that if you were to plant the seeds of possible stability, those are a couple of them that we want to kind of be on the lookout for. But again, just want to stress that we have a haves and have-not market. The upper two charts, where we've got our big blue chip companies in the S&P 500 and the Dow Jones Industrial Average, those are our haves. The two charts at the bottom with your high octane growth stocks in the NASDAQ composite and your mom and pop companies in the Russell 2000, those are your more speculative areas of the market, and they aren't doing us any favors right now. They are the more bearish ones. And remember, if you're trying to take the temperature or the health of the market and try to determine what its risk appetite is, you want to see these bottom charts doing better than the top ones ideally. A lot of times money drifts towards those blue chips of the Dow Jones Industrial Average when it is concerned about the risk appetite of the general stock market. And that is what we are seeing now. We talked a lot about Coca-Cola as an example in my question and answer session earlier today as kind of being a quintessential example of a company that's benefiting from that flight to quality here all of a sudden when it had been kind of forgotten about in recent years when the rest of the momentum stocks were doing so well. So a lot of things going on here right now, but it is an interesting market where we've got two of the indices with strongly bullish postures currently and two of the indices with strongly bearish postures currently. So we've got the bookends there. Be on the lookout for, as soon as tomorrow, the S&P 500 falling to a weekly bearish posture as well. But in all likelihood, the Dow Jones Industrial Average up here will retain its bullish posture going into the weekend in all likelihood. As it stands, just to put a ribbon on it, S&P 500 was down 0.1% today. Dow Jones Industrial Average was down 0.47% today. NASDAQ Composite was down 0.13% today. Russell 2000 was actually up today. It was up 0.5%, but still remains below its falling 30-day moving average. Let's go ahead and take a look at our three green arrows chart here. And so this will be chart 4D for those of you following along at home. And let's go ahead and put in the $ comp in the NASDAQ there. So we've got a little bit of a change here from where we were on Tuesday when I was last with you. Remember, on that day, we still had three green arrows on these charts. But obviously, yesterday was a game-changing type of a day when the NASDAQ was down 3.5%. I thought Tuesday was a big day, right? That day, the NASDAQ was down. I was talking about how it was almost down 2% on that candle there, and it was followed up with a 3% down move the following day. So naturally, you do have some red arrows creeping in here all of a sudden. In fact, on those bottom two charts, three red arrow signals. Notice the pink background color now on the NASDAQ Composite and also on the Russell 2000. So again, that's yet another way to identify that if you're looking at these charts trying to determine who your leaders and your laggards are, it's pretty obvious that the two bottom charts here are our laggards, and up at the top, our leader is the Dow Jones Industrial Average. It's the only one at this moment in time that is retaining its three green arrows status. We've got that green arrow on the moving average back here in place from December 22nd. Same day we had the green arrow creep into place there with the MACD histogram, and then we've also got the stochastic just a couple days later moved to that green arrow status. A couple of those appear to be rolling over to a degree, so we don't know how long this will last. It is possible that as soon as tomorrow, while I don't expect the Dow Jones to lose its intermediate bullish posture on the market forecast indicator, I would say that there is a possibility that it does lose its green arrow on the stochastic indicator. You've got a little bit of separation there, so it's not a shoe-in for it, but if it was a big enough down day tomorrow, I could envision where a red arrow could creep in there on the Dow Jones as well. But what I haven't mentioned yet, but you might have noticed already, is the S&P 500 is one of those charts that does not have 3 green or 3 red arrow signals. It has a mix of green and red arrows. Right now it's got 2 green arrows, the moving average and the stochastic, but it does now have that red arrow on the MACD histogram suggesting that we have a loss of momentum in that index. So again, I would say the same thing looking at this particular setup of who our leaders and our laggards are. Dow Jones Industrial Average is our leader. S&P 500 comes in second. Russell 2000 would be third in my book, and then the NASDAQ Composite fourth, but NASDAQ Composite sitting at a very interesting support level, so we'll see if that might be incentive for traders to spike it up in a kind of a counter trend move. A lot of that will depend on the interpretation of the jobs report tomorrow. All right, let's go over here to the internet. I always like to get a chance to say thank you to those of you that help support the presentation. As I mentioned on Tuesday, as long as I'm getting over 100 likes on Twitter, I'm more than happy to give you a full-length presentation here. And you guys stood up to the challenge, and I appreciate that. 111 of you came out of the woodwork to click like for me there on Twitter. So keep up the great effort there. As long as you guys keep supporting this video, we'll keep on producing them for you for free. If we start slipping on that count, then we'll have to maybe think about a different route. But for right now, I'm glad that these videos are impactful for you and that you're willing to help support us there on Twitter and other social media outlets, as this free video does soak up about 3 hours of David and I's time. And so that's a minimum of 15 hours per week we are dedicating to a project like this that we don't make a penny off of. So you can understand why we have to have some mental justification in order to do it. And as long as we're getting 100 likes there on Twitter, at least we have some reason to hope that we are promoting our business to a degree on social media, and therefore you scratch our back, we'll scratch yours, et cetera, et cetera. Hopefully it's a good, healthy relationship there. So thank you to those of you that help support that. Earlier today, as I mentioned, I taught my question and answer session, so feel free to check out that recording if you are a premium member. David taught his portfolio management with ETFs class. Of course, nobody is better in the business at helping you understand macro conditions and how the different pieces of the puzzle are moving around based upon the Fed announcement and things like that. So make sure you're taking advantage of David's expertise there. Tomorrow he'll be teaching his technical analysis class at 1 p.m. Eastern time. Should be a great one as usual. If you were interested in my Q&A class earlier today, we did have a long discussion about how to interpret the DGI dividend stair-step chart. So particularly if you're one of our newer premium members, that would be a really good conversation for you. We also had a conversation about RGA as a dividend growth investing stock. We had a conversation about the top-down trend trading class, which kind of morphed into the DGI class eventually, but how we think about generating an income stream and whether it's better to do that directly from dividend payments themselves or whether it's better to create your own income stream by selling off slivers of your stock investment. We also had a conversation about the Investors Business Daily 50 list that sometimes you guys hear me reference there on Twitter. So if you have an interest in those conversations, feel free to check out the recording from earlier today. Also, I've posted the factor selector to our website. This gets posted as of Tuesday night's closing information, but it usually gets posted to our website on Wednesday morning. Wanted to point this out because it is a bit of a sign of the times. We spent a lot of time in my factor-based swing trading class yesterday discussing this big move out of value here, out of the blue, and it is my expectation that the big driver behind that move is what we saw with energy and financials companies. Those are a couple of the bigger sectors within the value factor, and we are seeing value investors have their time in the sun here all of a sudden. Again, I'm sure that was supported today by additional higher movements in energy and financials. So at this point, I have no reason to believe that value will let go of its grip atop the factor selector when I put it together again next week. We also saw dividend yield move up in the ranking slightly. We did see a slippage there in low volatility as this market has kind of moved a little bit from the big blue chip defensive companies, just a little bit. It hasn't been ugly, but a little shift there from those types of companies into the more value cyclical types of companies like your energy and your financial companies there. And so some of those lower volatility stocks have not had as much appeal in that movement. Also keep in mind there's a fair amount of interest rate sensitivity in the low volatility factor due to all of the utilities and REITs that are part of it. And as most of you are aware, interest rates have been surging here more recently. So might be a little bit of a negative impact there as a result of that. Momentum stays dead last. And remember, out of these 6 different factors, momentum is one of the key ones when it comes to asking the question, is this market willing to take on risk right now? And right now is not a great risk-taking temperature when you see momentum dead last there at the bottom. All right, let's go ahead and get back on track with some other charts now. Let's do some 12-grid analysis, and we'll check out chart 5A here, which is the asset class 12-grid. A reminder that the background color of these charts here will tell you whether the intermediate posture is either bullish or bearish. If the charts are green, it's a bullish posture. If the charts are pink, it's a bearish posture. So let's start with the key one again today, and this was the key one I talked to you about on Tuesday, which is the U.S. Treasury Yield. This continues to sail higher. We are now at 1.73% on the 10-year Treasury Yield. And you can see that this is the 4th straight day of surging interest rates. When I was with you on Tuesday, I said it wouldn't take much for the TNX to break out to new 3-month highs. I was making a point out of the fact that in just 1 month's time, we went from multi-month lows to basically breaking out. And that did, in fact, happen yesterday. Yesterday was the breakout day on TNX, and we did get above that level on the 24th of November, and we got above that level on the 22nd of October. Today continued that follow-through right there. So keep in mind that when interest rates go up, bond prices tend to fall, and that is usually the case. Notice something a little different on TLT here today. TLT was actually up today. We're going to talk about that a little bit more in depth in our trade application example here, but I just wanted you to kind of identify that right out of the gate. That doesn't happen all that often. Now, technically, the long-term U.S. Treasuries is looking a little bit more at like the 20 and 30-year bonds as opposed to the 10-year down here, so that probably explains it, but just pointing out the fact that that normally does not happen. Usually when interest rates are up, they're up across the board, and therefore most types of bonds are down across the board, and that was not the case here today. We also saw high yield bonds close a little bit higher today. It was basically flat, but a reminder that high yield bonds sometimes gets the added benefit of what's happening with oil prices. Notice that oil prices were up 2.6% today, which is a pretty good day for oil. And you'll notice here that that kind of helped boost high yield bonds as opposed to, let's say, foreign bonds. Remember that high yield bonds are corporate bonds, and high yield bonds are raised money typically from corporations that cannot access cheap capital elsewhere. So that's why they call them junk bonds in the end. And so a lot of the corporations that have raised junk bonds in recent years have been oil and gas companies. And so on days when oil does really well, high yield bonds can do a little bit better than they would have otherwise. So that might play a little bit of a role there. So a lot of things going on there with the interest rate environment. Most of you have heard by now, of course. David, I'm sure, covered this with you in last night's video with the release of the Fed minutes and the expectation of tightening happening sooner than the market had anticipated, and perhaps even raising interest rates will happen sooner than the market anticipated. So there has been legitimate news to drive this interest rate movement higher. My question is, how much further can it go from here in the short term? The reason I ask that question is it has exerted a lot of energy to go from multi-month lows to multi-month highs as quickly as it has. Yes, this is a breakout, but one of the questions I have is, did it exert too much energy just getting to the breakout point? And if so, is it going to fizzle rather quickly after the breakout takes place? So for instance, over here on the US dollar, you'll notice that it's kind of been stuck in a bit of a funk here more lately as well. And so, it's not really been lighting the world on fire, and it's been pulling back more gently. Notice over here on the TNX, it really fell hard. It wasn't gentle. It was ripping your face off to the downside type of a move where you literally had a lower high and a lower low here. Right? In this chart on the dollar, we didn't really have that. You have a pretty decided low there, and this follow-up low is easily above it. So if the dollar were to break out above its recent highs, I think that stands a better chance of a stronger continuation move to the upside. My fear with TNX, now that it has broken out as of yesterday afternoon, is it exerted so much energy just to get to that breakout point that I'm concerned that it might not have the oomph to keep on going. Maybe it coasts a little bit, but I don't think we're going to get this type of a move that we just saw in the last couple of weeks repeated on top of this breakout zone here. So we'll all find that out together. Also note there on TLT, we had some oversold cluster signals the last 2 days before today as well. Other movements of interest, Bitcoin continues to be in the news. It was down a touch yet again today. Remember, I called it kind of the boy who cried wolf on Tuesday's presentation because of all these clusters that are coming together here, these oversold clusters, and this particular asset class not really reacting at this moment in time to those oversold cluster signals. And so I was comparing that to TLT, which oftentimes does react to it because it doesn't get to oversold all that often. Bitcoin, because of the extreme movements, does have oversold and overbought clusters quite regularly. So they're less reliable, I guess you might say. There was some interesting NFT news after the bell tonight on GameStop. Of course, traditionally not a company that means a whole lot to the market, but after last year, it became a meme stock, and GameStop, I should say, is up like 20 or 30% after hours here tonight on the news that they're going to start selling, I think it's like either NFTs or digital clothes for the video game characters or whatever it is. That's kind of beyond my level of expertise. But the point is, stock is responding very nicely to it. I'm not sure if that'll have an impact, but sometimes those types of themes do kind of roll together when we're talking about digital assets. So not sure if Bitcoin will use that as an excuse to have a little bit of a rally tomorrow, but it's tough sledding right here, right? Even if you got a big rally out of Bitcoin, you are so far below that falling moving average that right now the assumption has to be that this stays in a prolonged downtrend for the time being. You might have some reflex moves back to the moving average, but the expectation would be that it continues to roll over like it has in recent months. So not looking so good there in the crypto land. In terms of the charts up at the top, notice that EFA is the only one in the green up there at the top. That is your foreign developed stocks. They did fall the last couple of days, but because they had enough oomph off of the lows here over the past month, they're kind of retaining their bullish posture for now. Notice that their compadres there in the emerging markets foreign space is still trading below its falling moving average. It does have, emerging markets do have the strongly bearish posture, whereas the foreign developed markets still bullish. And I think part of the reason behind that is we were able to get up and over the moving average on the developed markets, whereas the emerging markets just went up to the moving average and then rolled over again. So of those two, it seems like going towards the more blue chip from a country perspective, foreign developed areas seems to be a little bit safer right now than what we're seeing in the emerging markets. Let's take a look at some sector analysis now. Normally I look at our market cap weighted version of sector analysis. Let's shake things up a little bit here today, and let's look at the equal weighted sector analysis, chart 1G in this case, for those of you that are following along at home. So this is an equal weighted version here, basically, is the way that you can think about this. So every one of the components is equally as important as the others. Remember, in the market cap weighted normal version, something like Apple is going to be way more influential than another smaller technology company. So this kind of, evens things out a bit more. And it is what we use a bit more often in my Monday top-down trend trading class, where we're using this information to help us make better decisions within our trend trading portfolio. Now, when you look at the color schemes on this, the green ones mean those would be the ones that are ranked in the top 4 on our WAR score methodology. WAR is just simply an acronym that stands for weighted aggregate returns, where we're taking return information from multiple time periods and we're weighting that after aggregating the data towards the more recent time periods more heavily. So when we're looking at this, there is a little bit of a difference here. And it's kind of a continuation of what I shared with you guys in Tuesday's video, where I talked about the expectation in my own head that financials and energy would be rising throughout the ranks compared to where they showed up on the sector selector the previous week. And right now there has been a change that's taken place. Energy now is one of those top 4 slots with the green background color. Remember, as of Tuesday, that was not the case. Technology was still one of those top performers, but now we've seen enough movement in energy. And look at this last week. So 3 out of the last 4 days, energy has spiked to new multi-month highs. At the exact same time, technology has basically been falling every day this week and is now all of a sudden trading below its 30-day moving average, at least on an equal weighted basis. So the chart of technology doesn't look terrible yet, but mostly because it had done so well before that it had gains to kind of give up. But it is true that there is a little bit more cracks in the system, as it were, when it comes to some of those high growth areas out there that were once carrying this market. And remember, that's a reflection of what we've already been talking about in this video, where you're looking at things like the NASDAQ composite being a laggard all of a sudden. That is kind of one and the same as recognizing the fall in technology here all of a sudden. And so money is clearly rotating out of technology and into energy. The unfortunate part about energy from my perspective is that, at least from a trend trading perspective, it kind of ruined a lot of charts here along the way for a lot of those individual oil and gas companies. So while it's great to see it back at highs, this was a pretty ugly path that it had at the end of last year. Now we compare that to something like the consumer staples at the bottom, and we don't really have that same feeling, right? The consumer staples are also at multi-month highs pretty much at this moment in time, but it's been building upon itself for the last several weeks. So it's a slightly different feel from that perspective there. Materials also looks pretty strong from an equal weighted perspective here. They put in a new high yesterday, pulled back a little bit here today. As I mentioned before, that was one of the more consistently red areas of the market, but this is a decent looking chart here on materials. And then real estate as well. Now, real estate had been absolutely on fire. So the last few days have not been kind to it as a result of rising rates. You've seen that give back in those interest rate sensitive areas. But because this had been so strong going into this week, that even after a nosedive for a couple of sessions this week, we still have a strongly bullish kind of look towards this chart. If it kind of stabilized here above that rising 30-day moving average, who knows? Maybe that's an opportunity to buy the dip on something like real estate. So we'll keep our eye on that possibility there as well. But I wanted to kind of shake things up there and show you that equal weighted version of the chart here tonight and see how things are slightly different perhaps from that perspective. Also kind of want to point out healthcare. Boy, healthcare gave us a little bit of a head fake there. They looked great a couple of weeks ago, surging day after day after day, and then for the last several days, they have absolutely torpedoed lower. This has now been 1, 2, 3, 4, 5 straight days of down moves in the equal weighted healthcare. Some of that is as a result of the biotech area, specifically the Kathy Wood types of stocks, those gene editing companies, and those disruptive types of companies have really struggled here more recently, and so that might have a little bit of a negative impact there within healthcare. So we've kind of got a little bit of a shakeup at the bottom. Remember, that was a few weeks ago. Pretty much all the defensive areas at the bottom were doing pretty well. Now there's some differences emerging, and those differences are that the consumer staples appears to be the strongest of the defensive sectors at the bottom, and healthcare is now the laggard of those, with utilities and real estate kind of in the middle, kind of dancing to their own tune depending upon what's happening with the interest rates at that moment in time. So that's a good segue into our trade application example for the day. Let me go ahead and pull up chart 3A. This will be our swing trading chart here, and I'm going to type in ticker symbol TLT. So we talked about this to a degree already, so I'm not going to belabor the point, but let's just kind of point out some things that stand out here on this chart. So as always, this trade is already done. What I ended up doing was selling a bull put spread, just like I mentioned I was thinking about doing on Tuesday. And a quick follow-up to that, I saw somebody mention in our class chats that something about Brandon thought it might be a good idea to buy TLT, and I'm like, wait a second, hold your horses. I did not say that. If I did say that, that certainly was not my intentions, and that's specifically why I said bull put spread. And in my eyes, buying something and doing a bull put spread are two completely different things. I am not a fan of TLT for the long term, so I want to be clear about that. I am willing to consider a bull put spread when things get a little bit out of control to the downside. And another way you can kind of interpret my actions on occasion is, you guys know I do a lot of selling of naked puts as well. That's not what I'm doing here when I'm selling a bull put spread. Remember, I've got the coverage in case I'm wrong on that. When I sell naked puts, I am typically more confident about that security, where I don't feel like I need that embedded, so-called hedge. When I'm selling put spreads like I'm doing here, I'm less confident about those situations, but intrigued enough where I'm willing to kind of roll the dice there a little bit. So I do want to be clear on that, just in case people are misinterpreting what I'm saying. So I'm not a huge fan of TLT here, but what I do recognize with my eyes is that this has gotten a little bit out of control to the downside. And I'm wondering if now is a time to be kind of counter trend with it. I've done a trade like this quite often throughout history. Remember, David and I have been doing these videos for many, many years, stretching back to our prior time with TD Ameritrade as well. So some of you that have been watching these videos over the years kind of know my style and some of the different trades that I've done along the way. And I am somebody that's done the selling of the put spreads on TLT on a fairly regular basis, maybe a few times per year. And typically when I do it, it is when they are in an oversold condition, which appears to be the case right now. Part of the reason for that is I almost have to. Other times, if I'm trying to do a bull put spread on TLT, I have to wait till they're blasted out because that's the only time when volatility rises enough to make my credits worthwhile. So part of it is I almost feel forced to do it. If I'm ever going to do it, it's the time when they're bombed out and volatility has risen dramatically and my strike selection is a little bit more attractive than it would be if you were just like selling a put spread on a bounce day up and off of a moving average like was the case back here in the middle of December. So my style is wait for that bombing out to take place. And I'm wondering if that's kind of where we're at right now with TLT. Notice that prior to today, we had two oversold cluster signals there. And again, that occurs when the green, the red, and the blue lines are in the lower reversal zone on the same day. Now, that's not a guarantee of anything, but kind of going back to that conversation I mentioned before about Bitcoin, the way I think about this is about the story of the boy who cried wolf. If there is an asset class that does not typically have a lot of volatility, and that's the case here with bonds, right? This is a bond ETF, and it all of a sudden does have a bout of extreme price movement to the point where it actually gives you an oversold cluster signal, that's a situation where I might be brave enough to take the other side of the trade. Now, I'm somewhat brave because, as I mentioned before, I'm not entirely brave. Otherwise, I would be buying calls or buying TLT outright or even selling a put all by itself. But instead, I'm just moderately brave, saying, this has gotten a little bit overdone to the downside. I'm willing to kind of give it a shot by selling a bull put spread where if I'm horribly wrong on this and interest rates do continue to surge in the next month or so, part of that put spread by having two different strikes is the hedge in that particular trade where I have defined risk within the trade itself. Now, if I were to go back a little bit further on this, let's do a 6-month daily view here. I wanted to point out another time period where I was talking about a similar trade. It would have been back here in the fall where I was talking about how TLT appeared to my eye to be looking like it was doing a bit of a head and shoulders pattern. In this case, this would be considered an inverted head and shoulders pattern, which tends to be a more reversal type of a pattern. Now, looking back in hindsight, that appears to have played out very nicely. Notice that the left shoulder ended up having an oversold cluster signal in it. A week or so later, it then went down and formed the head where it did give us more oversold cluster signals. It rallied past that, came back down to form that right shoulder, and then took off. So I'm mentioning that here because I could be early here, right? We've only seen a couple of clusters form. What if this is the left shoulder? What if it rallies a little bit in the next couple of days and then a week from now it's down here at 140? That's not going to make me feel too good, but if it plays out the same way as this one did over here, that might be about the end of it, and then we start pressing a little bit higher there after the fact. So be on the outlook for that possibility. Remember, when I'm selling a bull put spread, in this case I sold the February strikes. I think I did the 139, 137 bull put spread. You can check that in the Telegram app if you are a premium member of Market Scholars. You can get my fill prices and all that kind of stuff there. Remember, I do these trades during the market open, and then I send that trade information out to everybody before the market closes, so that way you guys that are premium members have access to that information before everybody else. But anyway, trade's already done, and it is possible that this is not the low. But what I'm curious about is if we're close enough, going back to that concept that I mentioned before on TNX, where this has been such an explosive move from the low that it makes me wonder, does TNX have the oomph to keep on sailing higher day after day after day? Or is this going to be one of those breakout failures for a while? Now, again, I want to stress, from my perspective, I do think that interest rates will go higher over the longer term. What I'm curious about is in the short term, if we've gone a little bit too far too fast, and that's why I was willing to put on this bull put spread here today, once I've recognized that we've had these oversold cluster signals, hoping that we're in the vicinity of a short-term bottom, which, as you've looked back throughout history on TLT, when you get those oversold cluster signals, more times than not, you are somewhere in that vicinity of finding a bottom on on that bond ETF. Okay, so that's what I had for you here tonight. Again, I appreciate you checking out the video. If you got value out of tonight's presentation, I ask one simple request out of you. Click like for me there on Twitter. As long as we're getting enough support there on Twitter and social media, we'll continue to do our best to produce these videos for you, and I hope to be with you once again on Tuesday. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.